We're half an hour away from the Open in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Let's get straight to it, shall we? Our top stories today across markets. Caution is the dominating theme as traders position for a potential second Trump presidency, with the anticipation of volatility around tariff threats, of course, looming in a couple of months. Meanwhile, of course, you have Donald Trump picking a 39-year-old Ohio Senator JD Vance as his running mates in a generational shift for Republicans. And also ahead here, Fed Chair Jay Powell flags growing confidence on inflation as traders boost bets on multiple rate cuts this year. Plus, we're pivoting to China with investors here getting a path to bets on Saudi stocks. You have two ETFs debuting today in Shanghai and Shenzhen. We speak exclusively with the CSOP Asset Management CEO, Chen.
All right, two driving forces in these markets here this morning. It's still that Trump 2.0 trade that continues and taking a bit of a deeper hold across some assets here this morning. And then that Jay Powell interview with David Rubenstein talking about they're getting a little more confidence in reaching that 2% inflation target. So certainly what we're watching very closely is that yield curve out of the U.S. and the steepening trades, which was basically a widowmaker in the first half, that is really gaining more steam now. So we're watching very closely after we did see the 2s and 10s, the 2s and 30s. In particular, that's the one to watch here, uninverting for the first time since January. That could be a Powell trade, also a Trump trade as well, as we were talking to our MLive team yesterday about as well. Base metals are definitely in focus after that weak across the board data that we got out of China yesterday as well. And we have the likes of Goldman Sachs. You know, they're talking about the Fed, too. There's a solid rationale now that they could actually cut in July. But keep in mind, they didn't change their forecast of September as the first cut in this easing cycle. So certainly they said there is a solid sort of case now to maybe that we could see some movement from the Fed in July. Equity markets are doing this. Japan coming back online. So you're seeing a little bit of a catch up there, but not a whole lot going on. But you take a look at how these Trump trades are going. So we talked about the 2s and 30s. We're back in inversion, but certainly briefly we did touch above water there. And also we're watching very closely that 30-year yield now inching closer to 443. The Mexican peso, so we're reversing the initial weakness here just a little bit, but still one of the most sensitive to sort of the Trump headlines that we've seen in the past 48 hours or so. And 64,000 for Bitcoin. We jumped the most in 2 months yesterday, Dave, and we're watching how the China setup goes. It was a massive drop in the Nasdaq Golden Dragon last night as well, just on the back of that weak GDP print here. We also had Goldman coming out, lowering their growth forecast for 2024, 4.9%. from 5%. So it looks like unlikely to maybe hit that growth target for the year, according to Goldman. Futures are set up in the negative territory here this morning. 10-year yields haven't really moved too much. We're still talking about 224 levels here and 727 for the currency.
Yeah, so we're looking at crypto stocks. We're looking at some of the EV plays. Solar also took a big hit overnight. Baidu was down also substantially. So tech in general also pulled back, as Yvonne is pointing out. 3% drop on the HS Tech Index yesterday, which I think if you put it together with a drop on the Golden Dragon Index, effectively you had sort of your long-duration growth names taking the biggest hit in about 7 weeks or so on an index level as well. Now, on the CSI 300, the 100-day moving average is still very much in focus there as a key support level. At least we've been hovering in and around those levels here. Now, talking about onshore stocks, we have two ETFs, well, at least two ETFs debuting today. We even have one, in fact, on a CSI 300 tracker here in Hong Kong, but we can set that aside for now. One in Shenzhen, one in Shanghai. Closely linked. We'll talk more about this, of course, later on. We'll be joined, as we were mentioning earlier, with the CSOP boss who'll be talking us through, of course, why they did it, how much they're charging, and where they think assets are going to be here. And also revisions to growth projections. So Yvonne is talking about the Goldman Sachs revision to growth this year. So they took away a little bit of growth this year. They put that on top of growth next year. Do expect possibly more banks to follow suit following the second quarter GDP print. And, of course, this hour is the weekly briefing from John Lee.
Yep, let's get more on our top story here this morning. Donald Trump has officially secured the Republican Party's nomination as its presidential candidate 2 days after surviving an assassination attempt. Trump also announced 39-year-old Ohio Senator JD Vance as his running mate, marking a generational shift for the party. Here's what President Biden had to say about Trump's VP pick.
He's a clone of Trump on the issues. A clone of Trump on the issues. So I don't see any difference.
Let's bring in our news desk editor, Jill Deese, is here. So Biden calling JD Vance just a Trump clone. But what do you think was behind this pick?
Yes, I think there's a couple of things here, Yvonne. So first of all, as we've said, a generational shift for the party. Trump is 78 years old. JD Vance is 39 years old. I mean, you're looking at a 40-year difference between these two guys. If you're concerned about the age at the top of the ticket, you certainly have a pick in this VP pick to maybe assuage your concerns about that. If you are a Republican. Aside from that, though, I mean, this is really JD Vance is a candidate that really kind of embodies a lot of that MAGA white working class populist attitude that Trump has really kind of, taken on as his entire persona in this race. I mean, so J.D. Vance became a senator from Ohio, Republican senator from Ohio in 2022. But before that, I think was probably best known not for his venture capitalism work, but for authoring this memoir called Hillbilly Elegy. Came out in 2016, was really kind of the talk of the town after Trump got elected. It's really kind of speaks to some of those white working class populism issues. So you've really, I think, sort of embodied somebody that really believes in the Trump mantra there. It's not, if you're a Republican and you're concerned about maybe, former Vice President Mike Pence, whether he was too establishment relative to some of Trump's politics here, in J.D. Vance, you have a candidate that's incredibly aligned with where Trump stands on a lot of these issues.
Although a few years back, wasn't he the one who described Donald Trump as America's Hitler?
Yes, and David, he has made a complete 180 from that point, as have many of Trump's supporters now, right? I mean, you've got within just Trump's cabinet last time around in the Trump administration, you had people like Nikki Haley, you had others who had very full-throatedly blasted Trump over various issues before making a big turnaround. So yes, in J.D. Vance's case, you've got somebody that went from pretty much really blasting Trump, criticizing Trump over various issues in very strong terms, as you just mentioned. And now suddenly, yes, he is fully on the Trump train here.
How does he then fit into the broader campaign? How does he help Trump win?
So at this point, I mean, look, America is already, it's incredibly polarized. So you're essentially just trying to win over either a very, very small amount of independents and trying to get them to, sway in your, various directions in different swing states, or you're trying to really galvanize turnout. So I think the hope for, a Trump J.D. Vance ticket for the Republican Party would be that J.D. Vance maybe has a bit of his age, maybe the fact that he's, at this point now incredibly aligned on Trump's policies and politics, that would galvanize the Republican vote and, increase turnout there. So I think that's maybe a little bit of the psychology here.
Yeah. Well, the average age is 60 between the two of them, right? Split the difference. Jill, thank you so much. Jill Deese, our news desk editor. As we were just pointing out there, President Biden has spoken with NBC News' Lester Holt, repeating that he intends to stay in the race for the White House. He's also defending his recent statement that his rival should be in the bullseye in light, of course, of the attempt on Donald Trump's life at the weekend.
The truth of the matter was, what I guess I was talking about at the time was, there was very little focus on Trump's agenda.
Yeah, the term is bullseye.
It was a mistake to use the word. I didn't say crosshairs. I meant bullseye. I meant focus on him. Focus on what he's doing. Focus on his policies. Focus on the number of lies he told in the debate. Look, 14 million people voted for me to be the nominee in the Democratic Party. Okay? I listen to them.
All right, we'll play some more snippets of that interview coming up here as well. We're going to talk markets with Mercer and how investors should position themselves as those Trump trades ramp up. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. It's day 2 of the third plenum in China as well, which, of course, we're still waiting for any signs of any announcements. Niall O'Sullivan joining us coming up next. This is The China Show.
I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. On inflation, in the first quarter we didn't make any more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. The U.S. economy has performed really remarkably well over the last couple of years. Today, I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning. We're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook, and also the balance of risks.
There you go. Fed Chair Jay Powell speaking with Carlyle co-founder and co-chairman, of course, David Rubenstein at the Economic Club of Washington. Keep in mind, of course, dual mandate. They've been focused on really one of the two in the last, 2 years, which is inflation. It's now more balanced when they look at the two, certainly, and with a cooling of the jobs market. So are rates coming? And when are they coming? September. And how deep do they go is the other question, too. Joining us here in set is Niall O'Sullivan, Global Solutions CIO at Mercer. It's good morning. It's nice to see you in the region. Hope you're well. There's then this pile of cash that's been going into cash strategies and just waiting things out. Now that there's a little bit more certainty over rate cuts, where do you think that cash goes?
I think it's, well, first of all, it's unfortunate that Chair Powell said he's not going to bring fun, and now I have to bring fun to the equation in terms of what's going.
There we go.
There we go. I think in terms of what they're saying, it's clearly he, I think, is watching the inflation data. Every Fed governor is wary of what happened in the past. They're very wary of repeating the mistakes of the 70s. So an idea that they would very quickly go to rate cuts was obviously going to be a bit of a challenge. You look at what's happening now, though, I think they're seeing enough coming through in the data. They know that at the start of the year you tend to get an echo of the inflation of the previous year as things reset, but now things are coming in, and I think they're increasingly having confidence. I don't think, and we don't think, that they will do anything next week, but I think they are set up for later in the year. And I think the second part of your question then, yes, one of the big things that's been driving global portfolios for the last number of years, that bonds have been a reasonable place to go, having been not a reasonable place to go for a very long time. But you will see now that beginning of the pullback as rates begin to fall, and people begin to think about how they can deploy, and people will start to edge out and get duration further out the curve if they can.
So these steepener trades seem to be picking up of late. Do you think that's something that we can gain more momentum on that? And is it really behind what we're seeing with what the Fed's doing and what could be doing and what Trump's saying as well? I mean, what's really driving that steepener curve?
I think the steepener is obviously some element of confidence further out the curve. So clearly, I think when you were seeing a lot of the times when people are worried about inflation coming because of future moves on the government side, then you begin to see the steepener reappear as people begin to get a little bit concerned about that, and that's what you'd expect. I think the interesting thing about the political environment, though, is on the things that would affect the steepener, the running a deficit and the like, both parties are actually quite aligned. There's not a major difference between the two. So we don't see any major difference in policy coming through on that side over the next while, whereas I think what will continue to drive that will be the fears about anything that might be inflationary coming back in the future.
How big of a problem still is inflation, you think? Or is that something I can still watch, but not watch with my full attention?
I think if things continue the way they're going, it is certainly under control. What has been the real positive driver has been you've had a tight labour market, and that obviously can feed through to wage growth, and wage growth will obviously feed through to inflation. What has been going on underneath the surface is that on the supply side, labour has been increasing. And that has actually been the thing that has been the escape valve. So we're looking at it from here, and you whisper it and you touch wood, but it does look like that they're going to achieve that soft landing and the things that they were looking for. Now, all hard landings start a soft landing, so therefore you can get humps and bumps along the way. But certainly our view at the moment would be that particularly the snackling on the labour side will result in the inflation pressures being reduced and enable the Fed to do what they would like to do on the rate side.
You've been talking to global investors and the like. I mean, what are they thinking now in terms of, do they tilt more toward risk for the back half? I mean, what are they looking at in terms of asset allocations now?
So one of the most interesting things we've been seeing is we do a survey with our colleagues in Oliver Wyman looking at the behaviours of the insurance side. And if you were to look at the insurance balance sheets globally, about 50%, 49 to round up, of insurers would say they have excess liquidity, and another 43% say they have ample liquidity. I think those sorts of things are encouraging them to think about trying to generate additional returns from their investments, and they can do it by moving slightly out the liquidity spectrum in addition to the duration spectrum. So I think one of the big trends we're seeing, particularly on the insurance side as an example, is people potentially moving more into private markets, and in particular moving into private assets that match their liabilities. That leads you towards areas like private credit and the like.
There has been a ton of money moving into that space. What do you think is the most overlooked risk right now? Because that is, a big part of the crowd is a relatively new crowd that's going into that asset class.
I think that's an excellent point. I think at an overall level, most of what's happening to date is replacement of banks. So therefore, as banks have been retrenching capital rules and the like, other sources of capital are coming in. However, your point about the new people coming in is exceptionally well made, because it's not just new investors, it's also new allocators of capital. I think one of the big risks is that new players in the marketplace will not understand the landscape the way others have. So they won't understand basic rules like sponsor back, do better in default. They won't understand how to write covenants. And so therefore, as you get a slowdown, and we will inevitably get slowdowns as points in the future, the tourists, if you want to put it that way, will not know what they're doing relative to the others.
The backpackers in some cases.
Hitchhikers. If they're hitchhiking, I mean, is it sort of taking shelter from what we're seeing across, this concentrated equity market, which seems like we're just kind of focusing on these winners of AI and the like? I mean, can you tell us a bit more? How do you even maintain a diversified portfolio at a time when everyone's kind of flocking to the same sort of trades?
So, and again, where you see this a lot is potentially in family office and not-for-profits and endowments type portfolios, where often you have people who aren't necessarily as experienced as the institutional side. And it's really difficult to actually say, well, how do you maintain diversification? What was the point of doing it? It's at its most difficult if you're talking to US investors, because there they had a low-cost passive option which did better than anything else.
Yeah.
I think when you're outside of the US, of course, people won't think this way, but you would ask the question, well, what if you had stayed just 100% domestic in your market? And in most cases, that would have been a worse thing to do. So I think you have to use the lessons of history, you have to look at what's going on, and you say at some point in the future, over the longer term, you need equities to generate the returns that you need. But perhaps you need some defence in your portfolio from having diversification as leadership rotates, as it inevitably will at some point in the future.
Yeah. And do you think, this is probably a philosophical question, do you think we are overestimating or underestimating AI?
I think, well, what's the famous quote from Mr. Gates? We overestimate the changes in the next 2 years and overrate over the 10.
Yeah.
I would look at inside even our own workplace what we are doing. So the broader models that are out there, we've actually used those models internally, but got it to learn from what Marsh McLennan's staff generally are doing. And the differences they're making to our day-to-day lives are real. So if you need to do something, the assistant is absolutely able to generate something that helps you do your job. And I think that will be the continuing trend. We did a survey from all the investment managers that we work with very recently. What we saw out of that was that, to date anyway, a lot of the AI is coming in on the data processing, the data harvesting, enabling you to do the job better. I don't think, other than people who already had quant-type shops, I don't think it's moving into the predictive side of things yet, but it will do over time, I think.
I got to ask you about China, since you're in this part of the world. I mean, how are you looking at this market here right now when the macro data still continues to be quite weak and this recovery seems to be kind of hitting the skids now?
So anytime we would make an allocation decision, you're always asking yourself, the questions around what are we seeing in terms of valuations, what are we seeing in terms of fundamentals, and what are we seeing in terms of sentiment. When we look at what's going on in China, you're seeing a bifurcation in the growth story. So the growth story overall is good, but if you were to look at what's coming from exports and international, it's particularly strong.
Yeah.
When you look at the domestic side, it's not as strong. So you put those two together, we think the overall growth story, i.e. the fundamentals, are not too bad. It's feeding through to, say, double-digit earnings growth, which can be interesting. And you look at the valuations, that's interesting. I think at an overall level, the big problem is the sentiment, though.
Yeah.
And we're going to need something that is causing that to change in the eyes of portfolio investors globally. And I don't think we've seen that yet.
Yeah, and we've seen, to your point, just quickly, if you could, we've gone to about 9-10 times earnings on the multiple. Do you think we ever return to about, the 12-15 times? Is the sort of key conundrum now investors are trying to grab? Is this cyclical? Is it structural? Does part of my previous allocation need to go elsewhere?
I think so. When we're looking at allocations at the moment, we are playing through broader emerging markets as distinct from specific focus on China. And the reason for that is, I think that question about that sentiment change is always very hard to put your finger on exactly when it will happen. I think when you look at the broader emerging markets, you see some other countries alongside that clearly have the similar, if you want, in terms of the fundamentals and the valuations, but probably more positive sentiment, and that's coming through on an overall level. I think the other point to note, of course, is in that broader EM basket, China is not the weight it once was, so the conversation can be a little bit more broader than it was before. But I think obviously at some point I think there will be a return to confidence, and as things start to rotate, I think people will move in. But it will be quite difficult to put your finger on exactly what it is will cause that sentiment to change.
Niall, it's great to have you here. Niall O'Sullivan, Global Solutions Chief Investment Officer at Mercer, joining us here in our Hong Kong studios. That renminbi fix just crossing your Bloomberg now, and we're still heading around 713 handle here this morning. Obviously, we're still dealing with this dollar strength on the back of what we've been hearing with these Trump headlines. The dollar certainly is one of those Trump trades that we continue to track here this morning. Hang Seng pre-market, we continue to see some downside here of close to 1% in the pre-market here right now. Futures are still in negative territory and getting a little bit more pronounced right now. Plenty more ahead. This is Bloomberg. All right, live pictures out of Milwaukee at the Republican National Convention that is still underway here today. On the back of that, we're hearing from this Fox News interview with the newly pick for vice president for the Republican Party here. This is JD Vance speaking to Fox and talking a little bit more about, he will talk about the full-scale investigation needed into the Trump shooting, and he's very healthy, will be able to serve 4 years. And talking a little more about he's there to really advance the Trump agenda. We have to stop the flow of illegal immigrants. We have to make it hard for illegal aliens to work in the U.S. And talking a little bit more about energy policy, we can be the main source of energy in the world. So, as we say, he is the populist sort of protege here and really supporting a lot of these protectionist sort of policies that Trump has talked about.
Yeah, and you as viewers, of course, are watching simultaneously as well the interview that's being played out, of course, with the U.S. President Joe Biden. The latest lines coming through there is that that he will, as expected, debate Donald Trump again in September. Earlier, they agreed to that earlier as well. So nothing has changed, that he will, of course, still continue to run on the Democratic ticket as their bet, of course, for the U.S. presidency. Right, going into the open today, just under 4 minutes away, we're looking at futures pointing, and early indications are we are going to get another downdraft, in fact, substantial in the early goings, 1.3%. We were down 3% yesterday. Support levels in focus. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down the open of markets here, and certainly, while we're focused on these Trump trades, which actually helped a lot of these U.S. stocks hit records once again overnight. In the Asia session, I think maybe we are a little bit more worried about the whole protectionist sort of tariff threat here in this part of the world, particularly when it comes to China. You're just hearing from Fox News here. They're also talking to the new vice president she'll pick for the Republican Party, JD Vance. He's already saying China is the biggest threat to their country. Yeah, there we go. We know where the starting line is as far as that conversation is concerned. And certainly you take a look at what happened overnight with the U.S. equities continuing to hit new highs, and then this massive pullback we saw in the Golden Dragon Index and some of the ETFs, of course, there that did see some outflows. This Trump trade vis-a-vis, of course, where you are on the short trying to trade one of the same thing, right? The different sides of the same coin. We're down 0.3% in the open on the Shanghai Composite, down about 0.25%, as you can see. We're entering, of course, day 2 of the plenum, more on that third plenum to be more specific. More on that in a moment, but as you can see, just about every single one of the heaviest weighted stocks onshore are down. So we'll talk about Ping An in a moment because it's a convertible bond story. We're down 2% in the A share. We should be seeing also some downside here in Hong Kong. Right, let's flip the page and have a look at what we're doing in Hong Kong. We're coming off a 3% drop on the Hang Seng Tech yesterday. We're adding another 1.25 to that. Tencent is down about 1%, which is
quite curious, given the fact that you are getting long-duration assets coming back in favor. But again, long-duration assets in China have been counterintuitively, but understandably so, negatively correlated to what you are getting across most of the other parts of this world. Okay, a couple of movers to tell you about. So we had the industry numbers from the big five automakers in China out yesterday, plus 2.5% across the big five. One of the big five, in fact, the biggest of the big five as far as May or June data, which is BAIC, down 0.9%. On your screens. Ping An is down 3.5%, convertible bond. Also the conversion, there we go, thank you so much. A conversion price of 43.71, which before the drop today was at about a 21% premium to the close yesterday. Lenovo also raising some money, warrants 1.64, and Baidu did get a downgrade out of Citi. The ADRs and the new price target coming out of Alice Yap and her team, 155 a pop from 170 over at Citi. Yeah, so that's a story for now across these markets. Again, downdraft and extremely strong downward pressure on some of these tech plays.
Yep, and as you mentioned, day two of the third plenum here, that twice-a-decade policy meeting with lackluster growth figures really adding pressure on top of leaders to really boost support now. And the latest GDP print really had prompted Goldman Sachs to cut their growth forecast for this year. We spoke to their chief APEC economist, Andrew Tilton, earlier.
So in the case of China, we're really focused on the third plenum meetings this week, where we'll set out a reform agenda for the next 5 years. We're not expecting a kind of big bang policy stimulus, but certainly we'll learn a lot more about the focus areas for economic policy over the next 5 years.
Yep.
Yeah, meanwhile, you do have state media pushing this narrative of a stable and resilient economy. Here's a look at some of the headlines in today's China Brief. You have the front page commentary. We're looking at the Xinhua news agency, the official news agency, interpreting the latest data as a sign of a steady recovery, reaffirming China's role as a global growth engine. Now, it says the economy is set to gain momentum from these new reforms and that the growth rate was not easy to achieve because of external headwinds, including, we were just talking earlier about JD Vance, of course, his latest comments on China as being the biggest threat, geopolitical conflicts, and some trade friction. Right, out of the Global Times, they're calling China's latest growth figures hard won, showing the economy's resilience while the fundamentals of its long-term long-term growth remaining sound and unchanged, I guess, is how they're framing that conversation.
Yep, so they're trying to make it more positive, I guess, on really what's going on. Let's get to our guest, Lillian Lee, for a bit more perspective. She is Vice President and Senior Credit Officer at Moody's Ratings. Lillian, let's start with that GDP print that we got yesterday, which is basically the slowest print we've seen in 5 quarters of 4.7%. Where are we? What phase are we now in this Chinese recovery?
Yeah. Hello, thanks for having me here again. So when we talk about the GDP growth rate, yes, we've seen that there are some good signs, but a lot more bad signs in the performance for Q2 moderation from Q1, which seems that the recovery is shallow at best. The strength remains in the manufacturing sector, high-tech sectors, as well as some export sectors, mainly led by the previous investment, heavily led by the state as well as external demand. While on the other side, for example, property sectors, we see that this sector remains depressed and sales and prices both continues to post the declines. We expect a 10 to 15% decline this year for property sector, but we do see some moderation signs in top tier 1 cities as well as some tier 2 cities, so that the pace of the decline is narrowing. But on consumption side, the picture is pretty weak, that the property prices continue to decline, the wage growth remains low, labor market remains loose. That all points to that consumption recovery will likely remain soft in the next couple of months. And having said that, the export sector manufacturing are strong, but geopolitical tensions remains a very challenging environment, especially in this U.S. election year, as well as together with the slowing global growth outlook. Both are implying that export sectors remains, the outlook remains uncertain. So that leads to the momentum we have seen in Q1 or even Q2 may not carry through to the rest of the year and next year without material for further policy push. Yeah.
Okay, Lillian, just to maybe underscore what this means for the credit profile of the economy and corporates there. So I'm just taking us one line from the Moody's report, which I should note, you would know about this. This is about late May, so this is a few weeks old. But interestingly enough, as we question the policy stance and whether or not it's enough to offset what we're seeing weakless, one line from this: a track record of effective policy action in the past supports the current rating, which I believe is A1 negative. Is Moody's convinced, without a shadow of a doubt, that monetary and fiscal authorities have both the toolkit and the implementation capacity to counteract the current weakness in the economy?
Yeah, that's a great question. As we all know that the outlook has been changed to negative from stable. That actually mainly reflects the weakness in the economies coming from two sides. One is weaker growth in the medium term, and which are further being weighed down by the property contraction in the property sector. And then the second is the still elevating and probably rising debt levels and local levels. Yeah, so that will lead to higher financial cost that central government is going to put on to address those debt issues. So those are the two main weaknesses. And so far in the past 6 months, we think that the incremental trends from various sides actually appear these risks are balanced. First of all, the property sectors, we see that longer term it's credit positive, but short term the restructuring plans face some hurdles, and the measures could not fully address them. And then the second is on the local government plans, right? That actually clearly suggests the policymakers are aware of this situation, and they have clearly identified these situations. But the measures, again, will take years to address. So that's about a long-term versus short-term. Our ratings outlook is looking through the midterm. So it's a longer-term or medium-term views on China's sovereign ratings. And so far, as I said, we think that the risk still remains unchanged from last 6 months we have assessed them. Yeah.
So can you tell us, is an upgrade on the ratings unlikely at this point? I mean, what are you looking at in terms of factors that could change that outlook, whether it's an upgrade or a downgrade?
Yeah, sorry, I cannot really make speculations on rating. And the second, I'm not China sovereign analyst, but I can comment on the macro perspective. And as we commented in our publication, as we have said in our publications, any measures to address more effectively and with concrete progress to show that the local government is setting a sustainable financial model to address its problems, that could be credit positive. While other factors like protected the more defaults and probably more risk to see higher burdens, higher cost on those on the public sector will have a credit negative impact.
Lillian, we have two big events, one ongoing, the other one is upcoming. We have it's the third plenum, and of course we're going into the Politburo meeting. One is a longer term exercise in policy, the other one, as you probably know as well. You know, markets are looking at the latter as potentially we could get something that addresses some of the short term ills of the economy. What are your expectations in both the plenum and also the Politburo meeting?
Yeah, great. So the plenum, let's first talk about it. Plenum comes at a critical juncture and set against the slowing growth because China faces multiple structural and cyclical changes. We think that it will likely build on the policies that have been announced in the past year, targeting longer-term structural reforms, focusing on promoting productivity and sustainability. So those are more like longer-term issues, right? But more importantly, we think there are three areas that are worth to be watched out. First is the fiscal and tax reform areas. So via probably more like incremental increase in personal income tax, some reforms in the VAT-based expansion, as well as taxations on the resources or property sectors. These measures could raise overall local government's revenue ratio, improve equity, reduce precautionary savings, could also address the misalignment between spending and revenue collection for local governments. So they are credit positive. But we don't think in the short term they are likely to compensate the shortfall in the local government's revenue side. And then the second area is the productivity and high-tech areas of focus. They will continue to see focus, probably lead more concrete measures on supporting investment in R&D, more funding grants to scientific research institutions to foster a good environment for those high-tech sectors and companies, and also support private sectors and foreign investment via a little bit more opening up to these sectors. So this could bring benefits as well to the investment side. And third area is the financial sector's regulation. We've seen strengthened regulation in this area in the past couple of months. While the objective is positive, to improve credit efficiency, but without orderly and coordinated approach, we think that this approach, there could be risk to see financial depression as well as further damage on the private sector's investment. So those are the more longer-term structural reform measures we expect. On the short term, we think there could be more stimulus on the consumption side, although we haven't seen so far, right? No direct consumption stimulus is sectors. But there could be more support on the employment side as well as income growth side, so that to increase the sentiment of consumers and then continue to supports to the replacement of some of the consumption categories. And then on the other side, I will still say that they were largely likely to use supply side boost to industries, to sectors in those technology sectors, to promote a little bit more to oversee expansion as well as exports. Thank you.
Okay. Lillian, thank you so much for joining us. Lillian Lee there in Harbin, of course, in the north. She's Vice President and Senior Credit Officer at Moody's Rating. Okay, let's back here in I was going to say Hong Kong, but we're talking about Shenzhen and Shanghai today, because you have two ETFs there that are debuting today that track Saudi stocks. We're looking at, I think, well, the CSI 300's 31%. We should be getting the opening moves into price. 13 minutes into the session right now. Bloomberg Intelligence thinks the cross-border collaboration will need some time to actually gain some traction between, of course, where you are here in Greater China and, of course, in the Middle East. Senior ETF analyst Rebecca Sin is here with us to talk us through this. So, this is the first, at least onshore play to gain access to the Saudi markets.
So what happened was, you may recall last year, CSOP launched the first ever FTSE Saudi Arabia ETF in Asia Pacific, and this was the largest ETF launch of 2023. They gathered roughly $1 billion in assets. A lot of it came from the Public Investment Fund of Saudi Arabia, PIF. And so now this is the second step of the process where they have cross-listed their ETF into Shanghai and Shenzhen. So we have the Huatai Pinebridge CSOP FTSE Saudi Arabia ETF and the China Southern CSOP FTSE ETF. And so this is the second step of the potential Saudi-China ETF Connect or ETF collaboration that they announced last year. So it's backed by political governments. The PIF governor himself is in Shenzhen right now for the listing ceremony. And it's a monumentous day because ultimately this means that we are now one step closer to the ETF collaboration between Saudi Arabia and China.
You're saying it might take some time to gain traction. Why? Is it just the geopolitical risks involved? What else?
So with this ETF, there are several factors to consider. The first is performance. The FTSE Saudi Arabia is down 3% year to date. So relative to S&P 500 and Nikkei, the performance is lagging. The second thing that we have in China is the QD problem. And so this is a foreign ETF, so it will require QD. And what we found is that this year, a lot of the fund houses have ran out of QD quota. And as a result of this, some of the ETFs are trading at a 30, 40 even 42% ETF premium because the market has performed so well. Combine that with the fact that the China performance has been poor this year, a lot of investors are flocking to foreign investments. You know, the S&P 500 is doing well, Nikkei 225 is doing really well. And so as a result, this ETF is having to fight for quota within the fund houses. Combine that with the fact of most of the fund houses traditionally allocate to mutual funds because they have a higher management fee. Usually the fee is anywhere from 1 to 3%. This ETF is charging less than 1% in management fee. And so oftentimes the fund houses will allocate the QD quota to mutual funds over ETF. So they have a few factors that are going against them at the moment.
All right, Rebecca, thank you. Rebecca Sin there, our Bloomberg Intelligence senior ETF analyst joining us here in Hong Kong. Of course, in the next hour, we'll be heading to Shenzhen and speaking exclusively with the CSOP Asset Management CEO, Ding Chen, about those ETF listings and if any more are in the pipeline. This is Bloomberg. Well, Fed Chair Jay Powell says recent eco data is giving officials more confidence that inflation is moving towards their 2% goal. Speaking with Bloomberg host David Rubenstein, Powell highlighted the 3 latest inflation readings, but did not provide clear timing for a possible rate cut.
The labor market remained very strong, unemployment remained very low, and inflation came down at quite a sharp pace, particularly in the second half of the year, by a very large amount. And that forecast was almost unheard of. It was unheard of before 2023. So big upside surprise that year. This year, we had expected the economy to slow a bit gradually, the labor market to continue to gradually cool off after being overheated a couple of years ago, and inflation to continue to make progress. And something like that is basically what has happened. The economy is growing now at about 1.5% in the first half of the year. Most forecasters have about a 2% growth rate for the full year. The labor market, again, has moved into better and better balance to the point where I think you can now say it's essentially no tighter than it was in 2019 before the pandemic. Remember that the labor market of 2019 was a very strong labor market. So we're back to that place, no longer overheated. On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. So turning to policy, your question, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was moving sustainably down to 2%. We've been waiting on that, and I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. We've also said that we're a dual mandate bank. For a long time since inflation arrived, it's been appropriate to focus mainly on inflation. But now that inflation has come down and the labor market has indeed cooled off, we're going to be looking at both mandates. They're in much better balance, and that means that if we were to see an unexpected weakening in the labor market, then that might also be a reason for reaction by us.
Okay, I think I understand. So to put it in terms I can for sure understand, the markets are suggesting, the futures markets, that there's a 90% chance that the Fed will lower its discount rate in September. Do you think the markets know what they're talking about?
So today I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning. I simply, we're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook.
Fed Chair Jay Powell with Bloomberg host, of course, and Carlyle co-founder and co-chairman David Rubenstein at the Economic Club of Washington. I'm just glancing here to my left, and I'm looking at this pullback we're seeing across Chinese equity markets, led, but as you can see, tech, we're down 1.7% now on top of the roughly 3% drop that we had, of course, on Monday. So a rough start to the week, but as they say in the evenings, the night is young, and so is this week. Plenty more ahead. This is Bloomberg. Right, we are getting more from President Biden's interview with NBC News anchor Lester Holt. Now, Biden spoke about Donald Trump's nomination of JD Vance, of course, as his running mate, and he was also asked about his performance in their first debate. Have a look.
The idea that I'm the old guy, I am. I'm old. But I'm only 3 years older than Trump, number one. And number two, my mental acuity has been pretty damn good. I've gotten more done than any president has in a long, long time, in 3.5 years. So I'm willing to be judged on that. I understand why people say, God, he's 81 years old. Whoa, what's he going to be when he's 83 years old or 84 years old? It's a legitimate question to ask.
Yep, so therefore defending, arguments that he's not or too old to run.
Yeah, pushing back.
But yeah, we also heard from the vice presidential pick for the Republican Party, JD Vance, talking about Trump's age, right? He's still healthy. And really, why they chose him, right? 40 years is...
Well, he's literally half the age of either Donald Trump or
I think that's
Joe
why
Biden.
the Republicans had to kind of counter in that way, right?
Yeah.
That this is a new generational shift within the Republican Party. Look at this guy. He's only 39 as well. So certainly we're going to continue to watch all these interviews happening when it comes to Vance, when it comes to Biden as well. We're going to have a lot more on the way in the next hour. You're watching the China Show. We're taking a look at when it comes to stocks here this morning. Definitely in the back foot here when it comes to China, and watching very closely how this all plays out. Tech, in particular, getting a pretty decent sell-off here this morning. This is Bloomberg. All right, taking you live pictures out of Milwaukee here this evening, of course, as it goes underway in there. And the first night of convention, and there's a lot of anticipation of that whether we're going to see the former President Trump make an appearance at Milwaukee. This is, of course, it would be his first appearance since that assassination attack on him in Pennsylvania just a few days ago. So certainly looking to see. Obviously, we did hear there was a video message from him early on, just kind of kicking off the convention there. But yeah, I think that's what we're seeing there. There he is standing there, right, Dave?
Yeah, I think, so we're looking at the big screen through our live camera into that stage. That does look like, of course, the former president coming through. And, so the big news, of course, over the last, couple of hours or so, of course, his VP pick. And also, we did hear also from his VP pick as well, talking about how, among many things, of course, that China is the biggest threat to the U.S. economy as well. He is making his first public appearance since that attack on the weekend. And just to connect that to what happens in one side of the Pacific is having more obvious impact to what's happening here in the region here, with Chinese tech stocks selling off substantially on the back of concerns that these bets that Donald Trump will use. We can draw that conclusion, and we can draw that line now with the ETF drop that we had overnight and the follow-through weakness we're seeing across Chinese equity markets here in Hong Kong.
Yep, you see the Trump family there supporting as well the Republican official candidate now for president there. So certainly we'll continue to watch these pictures coming out of Milwaukee here. Let's bring in our news desk editor, Jill Desus. So obviously Trump making a very interesting appearance here at the RNC. I mean, this is just days after that shooting. What does it tell you?
Yeah, I think that at this point, obviously it does seem like momentum has certainly shifted in Trump's favor. I mean, remember, it was really just a couple of months ago that, we were all sitting outside of a courthouse in Manhattan watching him, be convicted on these federal charges. You've got like a really sort of stunning turnabout here for Donald Trump. Obviously, out of that assassination attempt, we also saw those images featuring him. I think there's been a lot of speculation over whether that will actually improve, his bid for the presidency. Obviously, this coming as Biden is still trying to recover and regain momentum after that really poor debate performance. But you just see him kind of returning to the stage here, kind of living in this limelight that he obviously really, really relishes in. We'll see whether that's reflected then in polling numbers later.
Yep, okay, here we go. Let's go take it straight now to the Republican National Convention. There we go. The former president, Donald Trump, is walking in. As you can notice, of course, his right ear is bandaged, given, of course, this is his first appearance since that shooting, that assassination attempt on the weekend.
Yes, that was where he was injured, of course, and those images, of course, which we've been talking about the last few days. But yes, there he is, walking into the convention there. I don't believe he's expected to speak. But then again, the appearance itself is certainly one message to send to the Republican Party here. This act of defiance that continues here just days after this assassination attempt here. And of course, as we talk about what the news has been his new VP pick, JD Vance, this morning too.
Yeah, in fact, we did hear, of course, from his pick for the vice presidency about an hour back or so. And interesting enough, right? So we're here, we're watching all of these things. We're also watching it quite literally unfold. We did hear from President Biden, of course. He had that interview. And almost parallel to that, you did hear, of course, from his VP pick, JD Vance, talking about how China is the biggest threat to the U.S. economy. So there is a domestic audience. There is also a global foreign policy context that we're getting a lot more details on as we look at, of course, Donald Trump there making his first public appearance since the rally attack. Jill, I'll bring you back in here. As we look at these pictures and conversation on what this means for China foreign policy, just your take, folding in, of course, the new information of his VP pick.
Yes, definitely. Obviously, JD Vance, his brand new VP pick, talking about how China is the biggest threat to America. This is really just kind of, emphasizing that this VP pick is well in line with a lot of Trump's incredibly protectionist policies or messages on China, the world's second largest economy. We've already heard Trump float the idea of maybe 60% tariff increasements on Chinese goods. I mean, this is a presidential candidate who obviously wanted to talk very tough on China during his first administration, and then has continued to really try to talk tough on China after that. Now, obviously, President Joe Biden, the Democrat, he's also had incredibly tough policies on China. We've seen a lot of curbs on, tech, semiconductors, that kind of thing. Under a Biden administration, Trump is kind of, in this position where you've got these two presidential candidates that are both trying to, act as if they'll be very tough. But yes, JD Vance obviously falling right in line there.
There he is, standing next to, of course, the Republican nominee, JD Vance, as well. I mean, talk a little bit more about how the party is strategizing around this pick as well. You mentioned it's a generational sort of pick here, given that he's 40 years younger than Trump.
Yes, Yvonne, look, I mean, JD Vance is 39 years old. Trump is 78 years old. In this battle of these presidential candidates between, Joe Biden in his early 80s, Trump is really only a couple of years younger there, right? So if you're trying to send a message as a Republican Party that you want to create this kind of generational shift, bringing in a 39-year-old candidate, the Republican senator from Ohio, is certainly one way to do that, while also mirroring a lot of those, MAGA policies that Trump has really embraced. You've got this candidate that really kind of embraces that idea of this white working-class populism effort. So certainly very aligned there on a lot of these incredibly hawkish foreign policy issues and the like.
Is there a risk for the Republican Party in choosing a candidate like him, being so populist? Is there, should they have found someone that was a little bit more maybe appealing to maybe swing voters, for example?
Well, this is ultimately the big argument here, right? And you're dealing with a country that's incredibly divided in a lot of ways. I mean, a lot of Republican versus, Democratic voters are pretty, committed to what they're going to vote for. Obviously, the message that Joe Biden's campaign is trying to emphasize here is that, tying Trump to the January, 6th insurrection attempts, trying to, paint him as this threat to democracy, this very chaotic force there. I don't really think that a JD Vance pick, where he's incredibly aligned on all of these policies, really moves the needle there. But ultimately, it may be that if you're trying to strategize here, you're trying to really turn out more voters. I mean, right now, you look at the polling, and Joe Biden is a few percentage points behind. He's really the underdog in this race going into November. So if you're just trying to galvanize your base, JD Vance pick certainly does that.
And just to the other side, we did also hear from the U.S. President Joe Biden. Your takeaways from that interview that just aired, of course, I think it was on NBC.
Yes, yeah. It was on NBC. So look, Joe Biden right now is in a very defensive position still, right? He's trying to get back on message, and he's trying to, again, turn this back around, go on the offensive against Trump, and sort of paint himself as saying, look, Joe Biden, he understands foreign policy. He's certainly been in politics for an incredibly long time. He's got this very consistent approach to how he deals with a lot of these issues. But Joe Biden is also in a position where he's still in recovery after this really, really poor debate performance against Donald Trump just a couple of weeks ago. There's been all kinds of questions about Joe Biden's mental acuity for office. And so, he's in this very tough position where he's trying to reframe the conversation and put this back on, how, he's painting Donald Trump as a disaster for democracy, that kind of thing. But that's been very difficult for him to do when he's really on that defensive, still answering questions about his age, his fitness for office, his mental acuity. It's really kind of put him on the back foot there. And so what you're seeing right now out of this interview is, Joe Biden trying to attack Donald Trump on different policies. Obviously, a bit of a sensitive and difficult thing to do that, given that the former president, Donald Trump, just survived an attempted assassination. So it really, I think, puts the Democrats in kind of a difficult position as the Republicans ride this momentum in the convention.
And it looks like they're debating again in September.
Yes, so that was what was ultimately agreed to. Obviously, a lot can change then. Yeah. I mean, we've just seen a lot change over the course of the past couple of weeks. So we'll see if that eventually goes forward.
Jill, thank you. Jill Dietz's our news desk editor. As, of course, we just showed those pictures of the former President Trump making its appearance at the RNC. Meanwhile, we're getting more, as we talked about, from President Biden's interview with NBC News anchor Lester Holt. Biden spoke about Donald Trump's nomination of JD Vance as his running mate and was asked again about his performance in their first debate.
I've seen pieces of it. I've not watched the whole debate.
And the reason I ask, because I guess the question is, are you all on the same page? Are you seeing what they saw, which was moments of, frankly, that appeared to be, you appeared to be confused?
Lester, look, why don't you guys ever talk about the 28 lies he told? Where are you on this? Why didn't the press ever talk about that? 28 times it's confirmed he lied in that debate. I had a bad, bad night. I wasn't feeling well at all. And I had been, without it making it, I screwed up. The idea that I'm the old guy, I am. I'm old. But I'm only 3 years older than Trump, number one. And number two, my mental acuity's been pretty damn good. I've gotten more done than any president has in a long, long time, in 3.5 years. So I'm willing to be judged on that. I understand why people say, God, he's 81 years old. Whoa, what's he going to be when he's 83 years old or 84 years old? It's a legitimate question to ask. It's not unusual. He's going to surround himself with people who agree completely with him. Have a voting record. I support him. Even though if you go back and listen to the things that JD Vance said about Trump.
Right, and we're continuing to see the movement in the markets pricing in further this higher probability that, when you look at the betting markets, at this moment in time, they're attaching the highest probability of a Trump win. This is the betting market. This is not polling, just to be more specific, than we've ever seen during this specific campaign, 70%. And as you can see, I mean, Bitcoin has gone up from about, we crossed 60,000 just in a weekend. We're now flirting with 65,000. And of course, the conversation around the yield curve, that uninversion briefly that happened overnight, we're at about flat right now. Is it down to Powell? Is it down to Trump? Or is it down to both? And sort of broadly economics and the optimism that's being priced on the long end as well. Very quickly, we're also looking at, I'm going to come up, it's going to come up on your screens. I think there should be the homepage here on the Bloomberg terminal for Bloomberg clients here. If you want to get a sense of what those betting markets are looking like, we've amalgamated the data. We've placed them in one specific part of the terminal. It's a function you see bottom of your screens. Do revisit this, of course, on a daily basis.
Yep, in terms of not just the Trump trades, but really kind of the Trump fallout here in China. You're seeing that basically in tech, right? So, there is that concern of higher tariffs here in this part of the world. That seems to be weighing on a lot of these stocks here this morning. Baidu, and that was down to, I think, 2 downgrades, too, from the likes of Morgan Stanley, as well as Citi on the ADRs on Baidu. So that's why we're seeing that stock down some 2% as well. But JD as well seeing a drop there. Ping On, though, that was coming out with a convertible bond, too.
Yep, Asia ex-China looking like this. Asia Pacific is slightly to the upside right now, and I'm being extremely, extremely generous there. Although, as you can see, U.S. futures, that's where the action is trading. Stronger dollar, stronger U.S. equity market. Yields are lower, stronger U.S. Treasury curve as well. Right, going ahead, looking ahead, what else is coming up here on the China show? We'll be speaking with, and by the way, speaking of the Chinese markets, 2 debuts today. Saudi plays listed in Shenzhen and Shanghai. And Ting Chen, of course, is the CEO at CSOP. She'll be joining us, of course, to discuss these trading debuts today. Plenty more ahead here at the show. Suffice to say, this is Bloomberg.
I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. On inflation, in the first quarter we didn't make any more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. The U.S. economy has performed really remarkably well over the last couple of years. Today, I'm not going to be sending any signals one way or the other on any particular meeting. So, just to ruin the fun right at the beginning. We're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook, and also the balance of risks.
Fed Chair Jay Powell there speaking to Carlyle co-founder and co-chairman David Rubenstein at the Economic Club out of Washington. Let's bring in our next guest, Felix Brill, the CIO of VP Bank. He didn't want to ruin the fun, but we got to ask you where the fun starts, really, for the Fed here. Are we getting more confidence of when these rate cuts are coming?
Well, he dodged a bullet yesterday a bit in the sense that he did not really confirm it, but markets are pricing in now September for sure. And if he wanted to change that perception, he should have done it yesterday, and he didn't. So I think almost September is a done deal.
Right. And asset allocation-wise, is this finally the moment for bonds? We've been waiting for this. Right?
We did. But yeah, actually we like bonds. Of course, they offer some yield, especially if you still look at the short duration side of things. But they might offer still some protection, downside protection, if the positive mood turns a bit more sour in equity markets. It doesn't look like that to be the case right now. Right. But doesn't mean it could change tomorrow.
Do you focus on the steepeners? Where in the bond market is the most appealing now?
Actually, we like very much high yield, U.S. high yield, because you get a nice carry.
Okay.
And you benefit from the inverted yield curve. So you get 7-8%, which is very nice.
When does that, we had a brief moment overnight where the yield curve uninverted, which, to your point, we still have carry, but at some point we won't have any carry as well. When would you look to change that view on duration?
It might be a bit too early still. I mean, what we see now is a bit of a Trump trade, I would say. And we see a steepening of the yield curve. Yeah. And there are reasons for that, right? Fiscal policy might become even more loose. Protectionism is not good for inflation. And that could all lead to actually more steepening of the yield curve.
I mean, is that a risk, though, that if Trump's policies are seen as a little bit more inflationary than maybe Biden's, that the Fed might have to hold on cutting rates a little bit longer?
Yeah, actually they are. I mean, even the Biden administration is not like the opposite of inflationary. They also quite follow the loose fiscal policy. They also were tough on the stance with China on the trade side. But if you take it together, like a tough stance on immigration, a tough stance on protectionism, on trade tariffs, and loose fiscal policy, that's all inflationary, and that is not good also for the U.S. dollar. So we don't like the dollar in the long term.
U.S. futures are seeing noticeably more upside than usual at this point in time. We don't normally see this kind of moves in the Asia session. But, who do I send a thank you card to? Do I send this directly to Milwaukee, where of course, Donald Trump is? Of course, can I draw that line?
I mean, I guess some guys in Silicon Valley are quite happy about the nomination of JD Vance, close ties to the tech sector. And they're betting on probably that this is going to be very good for them.
We're seeing when it comes to the China reaction is that there's this threat of tariffs coming out of the U.S. if, in fact, Trump does become a president here. The tech space certainly is selling off in some ways. How should I be looking at China? I know you just closed your overweight on markets there just about last week. Good call, it seems like, at this point.
Yeah, definitely. Well, it is actually a bit tough on the outlook for China right now. We've seen the data, the economic data yesterday. The backdrop is not very positive. There's severe headwinds for the Chinese economy. We still have the real estate sector in troubles. That takes time. We know that. This time around it's probably the same. There's a lack of domestic demand. And on top of that now add some additional tariffs. That is not the best prospect. And that makes it tough because there are not easy solutions for that for the Chinese government.
So you've closed the overweight, but are you still neutral? What China exposure have you kept?
We have China exposure kept via emerging market equity exposure.
Okay.
But that is on a neutral stance. So we are invested in emerging market equities. But actually there are other markets within emerging markets that in the short term at least look a bit more promising in China than China.
Like what?
I mean, of course, if you look at not like on the momentum side, Taiwan is still super interesting. You get the AI play, basically. Of course, valuation is not cheap, but it still could carry on, especially if in the US also that goes on.
Is that still the best way to play? I'll use NVIDIA, but the NVIDIA narrative, is Taiwan still the best way to play that story? Is Korea an alternative? If not those two, what else?
It could become a bit more of an alternative, but so far it's lagging behind. But if you look at Korea, at least in valuation terms, if you compare it to the last 15 years, it's close to the average valuation, whereas China has a high multiple on it, premium. So therefore, you could go for that, a bit of a value play with Korea and betting like in a second round effect also on AI there.
How about Japan?
It comes down to the yen. Pure and simple. It is.
So is that good or bad? So I can't sense the connotation you're giving there.
I mean, I must say it's very tempting. I mean, at these levels, the yen looks really cheap if you look at the purchasing power parity. But underlying, there's a bit of a risk to that as well. You know, like if there's an unwinding of all these carry trades, that could be disruptive. And then we know from the past that can be very fast, and that could even challenge the financial stability. So that is a bit of the thing to look at. And as an equity investor in Japan, you don't like the Japanese yen to strengthen. That's typically bad. So that is a bit the challenge here right now. But we let it run for the moment. But we're monitoring it closely.
What will you look for in that yen direction to change? Is it when they actually start hiking rates, or when the Fed starts cutting rates, that things will start to narrow a little bit in terms of rate differentials? I mean, what could actually change the trajectory of the yen right now, you think?
I think Japan is more in the driving seat than the Fed here. I think if you see a change in the monetary policy stance of the Bank of Japan, or more signals of interventions, I think that could be the tipping point. And then it could be fast. I think it's not then going to be a gradual strengthening, because then there might be some unwinding, as I mentioned, on the carry trades, and that could be really quick.
What do we need to talk about as far as risk? So we have more certainty on the election as of now. We have more certainty on inflation. Hopefully, that's correct. What's a known unknown? Like what's going to cause your pain trade?
I think it's all about being prepared. I mean, we're talking a lot about geopolitical risk for sure. We're always talking about that. It's not going to go away. Right. We should not be fearful. This year has shown that in terms of equity market performance. Yeah. But maybe we should not be too greedy right now. So be prepared. And for that, for instance, we like gold. We like the Swiss franc. I might be a bit biased. But we like the Swiss franc very much. It could also be a very good hedge against inflation in the US.
Okay.
Perfect. Okay, Felix, nice to see you. Let's talk again. Felix Brill, the CIO at VP Bank. I think we covered just about everything. The dollar stronger, as you can see, bottom of your screens. Plenty more hit here on The China Show.
Welcome back to The China Show. Here are some of the big corporate stories we're following for you. Hong Kong property tycoon Adrian Chang is listing his venture fund on the Swiss stock exchange. That's through a merger with Swiss-listed investment firm Youngtimers. The entity, called C Capital, will be based in Switzerland and will also include the full ownership of Jacoda Index portfolios, and that's a stock index licensing and research firm covering capital markets in Japan, Korea, and Taiwan. Swatch Group shares slumped the most in 4 years after sales and profit both tumbled on slowing Chinese demand. The group's brands, including Omega, Blancpain, and Harry Winston, saw a 70% drop in operating profit and double-digit falls in sales in the first half. The firm says it's slashing production by 20% to ride out the downturn.
Right, we're continuing to watch the sort of different sector-specific fallout we're seeing, of course, from this. The big piece of news, of course, in the last couple of hours or so, of course, the VP pick by Donald Trump. EVs in focus, and as you can see, we're down about in the order of about 3% across most, and most, I should also mention, are listed in South Korea. Speaking of supply chains, we're looking at some of these Apple-related shares that are traded in China, for example. We're looking at that, of course, and of course, the big news yesterday they're killing it. They're killing it in India. I think it was 8 billion, if I'm not mistaken, was the figure there out of Apple, said to surge 33%. And I suppose, of course, more on this story in a moment. We're headed into the Tokyo lunch break. This is Bloomberg.
$11:29 a.m. in Tokyo. Of course, Japanese markets coming back from that holiday. You are seeing a little bit of a climb, I guess you could say. Not really. It's a pretty marginal one right now. But coming back from that long weekend, there you go. You're seeing some upside when it comes to Nikkei and topics as well. Exporters are also rising here today, maybe on the back of this weaker yen. That also is a bit of a catch-up given the dollar kind of momentum we've seen around these Trump trades and the like. So 158 handle for dollar yen here this morning, and yields are ticking lower following what we've been seeing when it comes to the short end of the curve, or at least what we're seeing across Asian sovereign bonds here. We're down 2 basis points for your 10-year JGB.
Yeah, there's an element of catch-up, of course, right? So I think Japan is just coming back after the long weekend there, of course, going into the lunch break. And as you can look at how we're doing across the region, as you go into the lunch break over in Tokyo, I imagine some of our viewers and some traders might be headed to the gym, right, for the lunch break. Just remember, I guess, one more set, not one more selfie, right? No one cares so much. No one cares about that selfie as much as you do, to be completely honest.
I don't appreciate a gym selfie. No.
Right? It's save space on the cloud, right? There are more pertinent things that we could be putting up there on the cloud. Anyway, markets are rant over. Markets are doing this. No, in fact, you know what? No, okay, rant over. Okay, that's right. Right, let's talk about monetary policy instead of muscle. Fed Chair Jay Powell says recent economic data is giving officials more confidence that inflation is moving toward the 2% target. Speaking with Bloomberg host David Rubenstein, Powell highlighted the 3 latest inflation readings, but did not provide a clear timing for a possible rate cut. Have a look.
The labor market remained very strong, unemployment remained very low, and inflation came down at quite a sharp pace, particularly in the second half of the year, by a very large amount. And that forecast was almost unheard of. It was unheard of before 2023. So big upside surprise that year. This year, we had expected the economy to slow a bit gradually, the labor market to continue to gradually cool off after being overheated a couple of years ago, and inflation to continue to make progress. And something like that is basically what has happened. The economy is growing now at about 1.5% in the first half of the year. Most forecasters have about a 2% growth rate for the full year. The labor market, again, has moved into better and better balance to the point where I think you can now say it's essentially no tighter than it was in 2019 before the pandemic. Remember that the labor market of 2019 was a very strong labor market. So we're back to that place, no longer overheated. On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. So turning to policy, your question, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was moving sustainably down to 2%. We've been waiting on that, and I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. We've also said that we're a dual mandate bank. For a long time since inflation arrived, it's been appropriate to focus mainly on inflation, but now that inflation has come down and the labor market has indeed cooled off, we're going to be looking at both mandates. They're in much better balance, and that means that if we were to see an unexpected weakening in the labor market, then that might also be a reason for reaction by us.
Okay, I think I understand. So to put it in terms I can for sure understand, the markets are suggesting, the futures markets, that there's a 90% chance that the Fed will lower its discount rate in September. Do you think the markets know what they're talking about?
So today I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning. I simply, we're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook.
Fed Chair Jay Powell there speaking with Bloomberg host and Carlyle co-founder and co-chairman David Rubenstein at the Economic Club of Washington. And of course, it is day 2 of the third plenum in China as well, that twice-a-decade policy meeting with lackluster growth figures really adding pressure on top leaders to boost support. We asked some of our guests this morning about expectations from the plenum and China's biggest headwinds.
The property prices continue to decline, the wage growth remains slow, labor market remains loose. That all points to that consumption recovery will likely remain soft in the next couple of months. The momentum we have seen in Q1 or even Q2 may not carry through to the rest of the year and next year without material for further policy push.
So in the case of China, we're really focused on the third plenum meetings this week, where we'll set out a reform agenda for the next 5 years. We're not expecting a kind of big bang policy stimulus, but certainly we'll learn a lot more about the focus areas for economic policy over the next 5 years.
Right. And, you know, the conversation around the Chinese economy, right? There's short-term issues, there are structural issues, and really, in what way does China be able to navigate both? And really what's taking place, and this is really the topic of the big take today, is rewriting of China's economic, rewiring really of the economy has made things like EV, solar, and chips some of the new pillars of growth as the nation navigates this property slump. Let's bring in our energy reporter, Dan Mercer, of course, who is behind, of course, the big take today. He's in Beijing for us. And, you know, Dan, the question there is you have high-quality growth. What is high-quality growth, I guess, as a definition? And why is the President Xi Jinping pushing so hard for high-quality growth?
Well, high-quality growth can mean a number of things. But here in China, it's sort of come to, in reality, mean, you know, biopharmaceuticals, advanced manufacturing, chips, communications, and the 3 new, solar, EVs, and batteries. And Xi Jinping first started pushing for this idea of high-quality growth back in 2017. And he saw it as sort of the next step in China's economic evolution as it keeps moving up the value chain. And he wanted to push away from what has pushed growth over the past decade, which is the property sector, which is a little bit unsustainable, it's polluting, into these more high-end sectors that pay higher, that can be globally competitive with companies across the world.
And as we see, of course, these old growth pillars, as you say, you know, the property sector, even consumption is weakening as well, continue to spiral. How are these new sectors, these new 3, able to fill the gap?
Well, they're trying right now, and it's a big gap to fill. According to Bloomberg Economics, you know, property and all of its connected industries used to, you know, come up with about a quarter of China's total GDP. That's, you know, getting downgraded right now. It's on track to be down to about 16% of the total GDP by 2026. That's a huge gap to fill. But Bloomberg Economics thinks that between green technologies, your solar, your EVs, and your batteries, and between some of these more advanced manufacturing sectors, you can get that 8% gap. And so China's economy can come out of this in one piece. But it's going to take a lot of nimble work by policymakers and by a lot of these companies that are struggling right now, especially in the EV and solar sector. So it's looking like it's possible, but things are still a little bit questionable.
Yeah, and Dan, in the meantime, you know, we focus in on maybe the core of the economic issue, which is really consumer confidence. And I have to ask you then, amidst this transition, and I guess it depends where you work, how does a typical Chinese worker feel about this evolution or transition in the economy as a whole?
Yeah, this is one of the things we found interesting when we took our reporting trip to Suzhou. I was with this great reporter, Yujing Liu, and you know, we went to these, you know, factories. We saw GCL, an amazing company that makes, you know, low energy polysilicon for the solar sector, and they're paying their employees well. People who are on the campus were, you know, working hard. They seem pretty happy with their jobs. But we went outside of the factory and went around the city a little bit, and things are a little bit tougher. You know, if we talk to furniture store owners and just people who are working for travel companies and things like that. And everybody else was seeing a little bit more of the struggling side of the Chinese economy. I think that, if you're working in one of these great sectors, things are good right now, but there's been a little bit less of a ripple effect than the property sector had.
Dan, great stuff. Thank you. Dan Murtaugh there, our Bloomberg energy reporter, joining us out of Beijing. Coming up next, you're going to be speaking with the CSOP Asset Management as two ETFs focus on Saudi stocks debut in Shanghai and Shenzhen today. Chen joins us next. This is Bloomberg.
Okay, yeah, there we go. That did not mark, of course, our return to the office today, or us coming in. Of course, there are two trading debuts. Although it sometimes feels like when we arrive here, of course, our team sort of does a little bit of a dance. I'm kidding. You are looking at two trading debuts today, two ETFs. This is a Saudi play, it's an energy play. I believe this is the first onshore one. Of course, we have had one here in Hong Kong for some time now. The one you're looking at on your screens is the one that's listed in Shenzhen. There's another one that's actually traded also today as a debut in Shanghai. These ETFs are the first of their kind in mainland China, and they directly, of course, invest in the Saudi market via the CSOP Saudi Arabia ETF, which is listed, as we were pointing out here, in Hong Kong.
Yep. That happened last November, of course. So joining us exclusively is the CEO of CSOP Asset Management, Chen, joining us out of Shenzhen. Chen, congratulations, obviously, on the launch. There's been huge political backings when it comes to this launch of these ETFs here. But you take a look at the AUM of both of these ETFs. They seem to be quite small, at least below average, compared to what we've seen in previous launches as well. Why do you think that is?
Yeah, so actually, I think so for the new launching two ETFs, the AUM is not that, small, and the two ETF combined together is above 1.2 billion US dollar, 1.2 billion RMB. Given, this ETF is only have like 7 days IOP period time. And today, if you look at the trading volume is quite very good. It's the first hour trading volume is already above 150 million Hong Kong, 150 million US dollar, and we see quite a lot of interest in the theme of investing in Saudi. And I think you see the AUM is not that as big as Hong Kong one is because this is just the beginning.
Yeah, and the feeder, as they say. Chen, David here, I was wondering if you could, not sure if this is probably a dumb question, but why are there two? Why is there one in Shenzhen? Why is there another one in Shanghai? And what do those two have to do with the one in Hong Kong? If you could explain how the flows work in terms of assets.
Okay, yeah, that's a very good question. So basically, these two listing on Shenzhen and Shanghai Stock Exchange is still a cross-listing program based on mainland China and Hong Kong ETF cross-listing program. So basically, we also have two ETFs simultaneously listed on Hong Kong Stock Exchange this morning. So one is a feeder fund to our partner, Huatai PrimeBridge, which is CSI 300. And another one is a feeder fund to our group company, China 1000, which is also MSCI A50 ETF. So this is still a cross-border ETF cross-listing program. And The reason why Shanghai and Shenzhen, they all want to have Saudi ETF is because this is the first time, a major emerging market SIM ETF get cross-listing to Shenzhen and Shanghai. Yeah, and also you can see the enthusiasm and also optimistic from mainland Chinese investors to those schemes.
I'm just wondering what you're thinking about the potential of demand to pick up a bit more, Ding Chen, because I'm looking at market conditions. For one thing, the Saudi market hasn't done too well this year. I think we're down some 3% year to date. There's also concerns about the lack of the QDII quota for a lot of foreign investors as well. And maybe overall it's just the awareness of this market. I mean, how do you deal with these sort of hurdles here to boost more trading?
Yeah, so first of all, obviously this is a program needs to have QDII quota to invest. And second of all, you mentioned the Saudi market. And I think Saudi as a major emerging market because of the social and also economic reform and also their Vision 2030. And we see the Saudi market, the economy booming recent years. The GDP growth rates for the past 3 to 5 years is like 8.9%. And I think for Chinese investors, this is the opportunity, to get their money, to diversify their investment solutions and get a portion of Saudi, a small piece of Saudi market.
Right. And what type of investors would you be looking to jump in over the next few weeks? Are these investors looking to diversify more into energy, for example? What are the types of what are the investor needs that you think this product addresses?
Yeah, you're 100% correct. So for most of people here, they understand of the Saudi is based on Aramco and also the oil sectors. And on the other hand, people from mainland China, we all benefit from the reform, and they know the Vision 2030. They know Saudi market, the kingdom, is having major social and economic reform. So they are willing to participate in those reforms. Yeah, and also I think when we talk with the investors, they are, have a long-term positive view of the Saudi market.
Ding Chen, I wanted to kind of switch gears and talk a little bit more. You also did launch a CSI 300 ETF alongside these Saudi ETFs today as well. And there's been a lot of talk about, obviously some of these ETFs in China in general have been slammed by whether it's the threat of Trump tariffs, the ongoing election risk as well. But also there's been signs of maybe the national team has stepped in through the ETF market in some ways. What are you seeing in terms of flows right now?
So, for Chinese capital markets and also for the China A ETF in Hong Kong Stock Exchange, we see the price facing a little bit, turbulence recently with various of reasons. But still, if you look at the valuation and look at the economy, the growing of mainland China, and I think in the longer term, people, and also, we see, especially for this half of this year, we see investors' interest gradually coming back to China A market.
Okay, and some of your other products too, and hopefully we have time on the back of this to talk about the pipeline. But I just want to ask you, because you do have some products that where investors can gain exposure to non-China AI plays, so Samsung, for example, or TSMC. What are you seeing there as far as flows?
Yeah, we we see, we have various of products in Hong Kong, especially on Hong Kong Stock Exchange, various of ETFs. We have like China A, Hong Kong Tech 3033, and also we have a U.S. NASDAQ ETF as well, and also we have Asian low carbon ETF as well. From that, products you mentioned about, they have some portfolios and exposures on the semiconductors, and those ETFs, people are very interested, both domestic and also Hong Kong investors.
Ding Chen, thank you so much, CEO of CSOP Asset Management, joining us out of Shenzhen here this morning. We got plenty more ahead. This is Bloomberg. Some stories that we're following for you this morning. Bloomberg has learned that Salesforce has cut about 300 roles as part of its broader effort to streamline operations. Sources tell us that the software giant made the cuts this month following earlier rounds of job losses starting at the beginning of 2023. It's the latest example of the tech industry reining in costs following years of rapid hiring. Stripe's valuation has edged up to $70 billion as Sequoia Capital offers to buy shares from investors looking to cash out. Sources say Sequoia is offering to buy Stripe shares at over $27, with the venture capital firm reportedly buying up to $861 million in shares. Stripe helps merchants process customer payments and was recently valued at $65 billion.
Okay, we're looking at markets right now. So Trump trades, we're continuing to track this. So everything from the dollar to steeper trades, the steeper curve, as you can see. And we're looking at dollar Mexico. Bitcoin was, we were at 60,000 or even not even at 60,000 last week. We're now flirting with 65,000. And of course, the big news this hour is Donald Trump making his first public appearance since the attack on the weekend. And as you can see, there's a visible remnant of that attack, of course, and his right ear being bandaged there as well. A couple of other things here coming through out of the Republican National Convention. Of course, the other big news, of course, was his VP pick and what that means perhaps for foreign policy and after what that means also for his campaign domestically.
Yes, so he's 40 years younger than him, so certainly that helps in terms of maybe, define some of these concerns about his age and the like for the Republican Party, but also he is sort of that populist protege that they call JD Vance here. So certainly he is going to be advancing that Trump agenda when it comes to being a protectionist hawk on national policy, immigration policy, and it basically sits in the camp of, really kind of taking China to a head. So certainly that's going to be one focus here of why we're seeing a lot of these Chinese tech stocks in particular really reacting to this these Trump news. Yeah, we're down about 4 or 5% over 2 days, and fittingly enough, going into the rest of the session, U.S. futures are seeing some decent upside at this part of the trading session. We'll leave you these pictures. Thank you for joining us today.